Today we'll be looking at purchase consideration. Like I said when I was introducing the topic, we in the process of consolidating accounts of entities that are in the same group, one of the major thing we need to do, which is like the first thing we need to do, is to calculate goodwill. However, to calculate goodwill, we need three parameters, which are purchase consideration, the NCI value, and the fair value of the net assets. We have explained that to calculate fair value of net assets, that's why we do the net asset summary, which shows us what is the fair value of the net asset on the date of acquisition. We'll still come back to that as a subtopic where we'll look at fair value adjustment. However, to the first one, which is purchase consideration, is what we want to look at today. And if you remember when I was introducing purchase consideration, I said we actually have 4 different types of purchase consideration. Purchase consideration is what the parents paid to acquire the subsidiary. Is what the parents paid to acquire the subsidiary. The resources the parents exchange for the shares in the subsidiary. And we basically classify purchase consideration. We have 4 types of purchase consideration. And they are what? They are one, we have cash consideration. So we have share exchange consideration. 3, we have deferred consideration. And we have contingent deferred consideration. Contingent deferred consideration. So these are the 4 considerations we have, and each of these 4 has its own way that we use in they have the way we record and use them in consolidation. Okay, so for cash consideration is just where the parent company is paying immediately or paying cash for the acquisition of the subsidiary. When we say they are acquiring the subsidiary, we have established that it means they are buying the subsidiary. And to buy that subsidiary, what you are buying is the equity shares. That equity shares you are buying, some people owned it before, or some people owned it before, or even if nobody owns it, it is the money the business needs to run. And for you to now own that shares, you must have paid the money for those shares. So where we are paying for it outrightly, like when we are paying immediately for it with cash, that's what we call cash consideration. And in most cases where cash consideration is used, it would have been recorded. They will tell us, examiner will tell us it has been recorded. So where examiner did not tell you, if you look at some of those things, some of the illustrations we did on goodwill, where examiner did not even tell us expressly that this is the purchase consideration, like in this avalanche question we did. We came into the statement of financial position to check under the assets of the parent company, and we see that they have investment in the subsidiary worth 60,000. That was what we took as the purchase consideration. Why we have it here like this is because it is cash consideration. When it is cash consideration, the double entry will be to debit investment in the subsidiary. I mean, in the separate financial statement of the parent. Now, debit investment in subsidiary, you credit their cash or bank. You credit their cash or bank. That's for cash consideration. We don't really have much on it. But when we now talk of share exchange consideration, what does share exchange consideration means? Share exchange consideration simply means the parent company is selling their own shares to finance the acquisition of the subsidiary. Share exchange consideration is where the parent company is selling their own shares to finance the acquisition of the subsidiaries, or to finance the acquisition of the subsidiary. What that simply means is that they want to buy the subsidiary, but to raise funds to buy the subsidiary, they are now selling their own company shares. The sale of shares might be to the shareholders of the subsidiary, might be to external party, but what is most important to us is that they are selling their own company shares to finance the acquisition of the subsidiary shares. So what will be the purchase consideration in that case? Will now be the number of shares they are selling multiplied by their share price. For share exchange, it is the number of shares they are selling multiplied by the parent entity share price. Number of shares they are selling multiplied by the share price, which is the parent entity share price. However, to get this number of shares, at times it is expressed as a percentage or as a fraction of the shares they are acquiring. At times it is expressed, or let me say most times, it is expressed as a percentage of fraction of the shares they are buying. So they can tell you they are using 2 of their own shares for every 3 shares they are acquiring in the subsidiary. They can tell us that they are using 2 of their own shares for every 3 shares they are acquiring in the subsidiary. So if that's the case, the number of shares will now be 2/3 multiplied by, at times we don't even know the number of shares they are acquiring in the subsidiary, but we know what their percentage of holding is. Let's say is 80% they want to hold in the subsidiary, times the number of shares the subsidiary holds. At times they may not even tell us the number of shares the subsidiary holds. Then it will just be the ordinary share capital of the subsidiary divided by the nominal value. So when we do all of this, it gives us the number of shares they want to sell. Then we'll now multiply by the parent entity's share price, that is their own share price on that day, which can be maybe 2 naira or anything. Now, like I said again, when we are to calculate the share exchange consideration, it is just the number of shares the sub-parent is selling multiplied by the parent entity share price on that day. So the parent entity share price maybe is 2 naira, but to get the number of shares of the subsidiary, the number of shares the parent is selling, in most cases it is expressed as a percentage of the shares of the, it is expressed as a percentage of the shares of the subsidiary they are acquiring. It's just like saying, I want to sell my own assets to acquire your own. We are now saying I will sell 2 of my assets to acquire 3 of your own assets. That's just, in most cases, that's how they express it for us. So we'll do what? We'll do 2/3 multiplied by the number of shares we have in the subsidiary, the parent has in the subsidiary. And now said, in some cases, they may not even give us the number of shares the parent is acquiring in the subsidiary. What they will give us is the percentage of holding, as we see in some of the questions we did, that they did not give us percentage of holding, they gave us number of shares. We calculated percentage of holding ourselves. I think that was when we did question 6 or so. When we did question 6, they did not give us percentage of holding. We have to calculate it ourselves. Yeah, we have to calculate it ourselves. So if they did not give us that to calculate, we can just use that percentage of holding to multiply the number of shares in the subsidiary. And I said they can even make it a bit technical and not still give us the number of shares in the subsidiary. If that is the case, they still did not give us the number of shares in the subsidiary. Number of shares in the subsidiary will be the ordinary share capital of the subsidiary the ordinary share capital of the subsidiary less ordinary share capital of the subsidiary less the divided by the nominal value of the subsidiary shares. Now, another thing is where this share price is different from the nominal value of the parent shares, where the share price is different from the nominal value of the parent shares. Like I told us in the last class, you see, when we are giving something like this, ordinary $1 share, this $1 we have here is the nominal value of the shares, is the nominal value of the shares. And whenever you are selling shares at any value different from this nominal value, if the value you are selling is higher than this nominal value, we call that share premium. We call that share premium. We call the excess share premium. If the value you are selling is lower, we call the difference share discount, share discount. But we rarely see share discount because share discount is regulated. Before you can sell shares at discount, you have to get an approval from the Corporate Affairs Commission, and also I think get a court this thing before you can sell shares at discount. However, so if this price is higher than the nominal value, what do? We will now split it into two for the purpose of recording. The nominal value will be recorded as ordinary share capital, while the premium will be recorded as share premium. So that makes the double entry for share exchange consideration to be debit investments in subsidiaries, still the same thing as the debit we have here. But the credit will now be credit OSC, ordinary share capital, with the share capital portion of the share sales, and credit share premium with the excess of the share capital, with the excess of the proceed, generated from the share disposal, the excess of the proceed generated from the share disposal. Please, can you guys hear me? Do you understand?
Yes, sir.
We can hear you.
Okay, good. Okay, good. Do we all understand what I just explained?
Yes, sir.
Sir,
Okay,
please, can you
good.
explain the last part where you said when the 2 naira is higher than? I really don't get what you said there.
So I said where this value, the share price of the parent shares, is more than the nominal value. Nominal value is what they will give you in the statement of changes in a statement of financial position like this. They say ordinary share, $1 share, ordinary share at $1 or at $1.5 or at anything. That value they are giving you here is what we call nominal value. That's like the intrinsic value of the shares. So anything they are now selling it, if they sell it above that value, simply means they are selling it at premium. They sell above that value, simply means they are selling at premium. So when they sell at premium, the premium will be separated from the share capital itself when we are recording. So that means when we are recording, we will now have what? Debit investments in subsidiary with the whole figure, credit ordinary share capital, and credit what? Share premium, the portion attributable to each of them. When we are looking at illustrations, that will make it a bit better. So for deferred consideration, what does it mean to defer something? Deferring something just simply means we paying at a future date. Paying at a future date. So when we want to pay at a future date, it simply means we'll pay higher. Whenever we are paying at a future date, we'll pay higher than what we are supposed to pay because of what we call time value of money. You know, if you are to buy something for me today, I say 10 naira. You know, I say I will pay in the next 1 month. I will not agree to interest element. I want to charge interest on that 10 naira. So what we do is, for the purpose of consolidation, when we have deferred consideration, we believe the deferred consideration, the figure given to us is the future value that will be paid, except otherwise stated. Except they now tell us something else. But whatever value they say they want to pay is what they will pay in that future. B, or discount it back to today's term. We calculate what is the present value, what would have been the value if we are to pay today. Because you know, if we say okay, we'll pay 2 million in 3 years' time, you know, if we are supposed to pay today, it wouldn't have been up to that amount. So we'll discount that 3 million to today's term to see what it would have been today. And that what it would have been today is what we recognize in our books as the asset, is what we recognize in our books as the purchase consideration. Then that excess, the difference will now be recognizing it every year as discount unwound, like an interest element every year till we make the payment. What do I mean? To present value future deferred consideration. Now we use the formula A into bracket 1 minus, sorry, use into bracket 1 plus raised to power minus n. With this now we'll get what is the value of what we want today, and value calculated will now recognize in our as at today. Then subsequently will not be calculating the discount element on that payment that made it to be that amount they want us to pay in that future. We'll be calculating what is want us to in that future, and once we that discount that difference we are calculating, we will now be taking it as an interest element in our books. So for deferred consideration, the double entry will be to debit investments in the subsidiary and credit deferred consideration account. And the last one we have is contingent deferred consideration. For contingent deferred consideration, it's not really common for skills level. I don't think I've seen any question in skills level that tests contingent deferred consideration. But when we say something is contingent, you know, deferred consideration and deferred consideration itself is the contingency. Then the contingent here simply means that we are, but the payment is relying on the occurrence or non-occurrence of another event. It's relying on the occurrence or non-occurrence of which is mostly out of the entity's control. What do I mean by that? It simply means for contingent deferred consideration, we may have something like, okay, we are acquiring the subsidiary now, but we'll pay you whatever the share price is saying in 2 years' time. We'll pay you what the share price is saying in 2 years' time. Or we're acquiring the subsidiary now, but we'll pay you 10% of the profit in 3 years' time. We'll pay you 10% of the profit. Contingent deferred consideration. Fair value contingent deferred consideration, we fair value it, and the fair value is what we recognize on the date of acquisition. Is what will be the purchase consideration for that transaction. Then subsequently we'll be fair valuing the contingent consideration, and if it increases or decreases, we'll be recognizing that in our state plus discount transaction or an interest transaction. So let's look at some illustrations to back up all of this explanation, and we'll call it a time for tonight. We'll debit what investment in subsidiary, we'll credit investment in subsidiary, we'll credit contingent deferred consideration. Okay? Do we understand, or do I still need to go back on anything before I start solving questions? Hello?
Maybe because of your network, the contingent on the far consideration is not clear.
My network, can't you guys hear me clearly?
We did not hear you clearly. Oh. It's keeping.
Is it clear now?
Yes.
I said contingent sorry. Contingent deferred consideration sorry about that. So I take it again. Contingent deferred consideration is a consideration that will be paid at a future date based on the occurrence or non-occurrence of an event that is outside the management's control. So when we talk of contingent deferred consideration, it's just like saying, okay, we want to buy the subsidiary now, but what will pay you for this acquisition is maybe what the share price is saying in 2 years' time or in 3 years' time. Whatever the share price is saying in 3 years' time is what will be paying you for the acquisition. That's contingent deferred consideration because it is outside the control of the management. They don't know what the share price will be saying by then. So, or maybe we'll pay you a certain percentage of the profit or so what do we now do? For contingent deferred consideration, we have to fair value it. We have to fair value it on the date of acquisition. Is that fair value we recognize as the purchase consideration. However, year in, year out, till we make the payment, we'll be revaluing, we'll be checking the fair value. If there's any change in it, the change in the fair value will be recognized as an interest expense. Is it clear now? Is it clear?
Yes.
So let's look at it. I don't want to keep us up for too long. So have the subsidiary of its own ₦1 ordinary shares to pay for every 4 shares acquired. The market value of the paper required show the necessary accounting entry to the transaction. This is a share exchange transaction because they said they are issuing their own new shares to finance the acquisition of the subsidiary shares. So what do we do? To calculate the purchase consideration, what I prefer to do is to just split slightly. The ordinary share capital will be what? I said it is the number of shares acquired. Shares acquired wasn't given. Oh, they said they are gone. So the number of shares they are selling for the acquisition. The number of shares for every acquired. So 5 of their own shares for every 4 shares.
Sir, I can't see your
4.
screen. No,
Can others see my screen?
I'm seeing it now.
Can others see my screen?
We are seeing it now.
Then we will now multiply the price. But because I want to split it here, I will only multiply by the nominal value of the shares. Nominal value of the shares. Then to calculate share premium, I will repeat, but I will multiply by the premium on the shares. By the premium on the shares. What do I mean by this? This 5/4 times, 12,000 is the shares you want to acquire in the subsidiary. If we multiply it by 5/4, it will give us the number of shares they are selling to finance the acquisition. However, we are supposed to multiply it by 6 naira, but comprising things on the nominal value and whatever excess we have, treat it as share premium. So the share premium will be 5 naira. That is 6 minus 1. That's how we got this. So what's the figure? What is the figure, please?
$15,000 for the first one.
15,000.
75,000. So the summation will be 90,000. So what that simply means is that what will be to debit investment in subsidiary with 90,000, credit ordinary share capital with 15,000 share premium with 75,000. So question 9, what do we have? Can someone read for us, please?
P has a share capital account with ordinary share of 100,000 naira, 1 naira share each and a share premium of 52,000 naira if P acquired 12,225 naira shares in X by a share exchange of 2 of its own share for every one of X share acquired. The market value of the shares of P and S are 20 naira and 15 naira representative. Requires A. Show all the necessary accounting entry. B. Show P's new share capital and share premium balance. Done, sir.
Okay. So what do we have? We have the necessary their new share capital and share premium balance. So we'll say question 9. It is also a share exchange concern, and fortunately for us, they've given us all we need. So to calculate the purchase consideration, we'll have the ordinary is a share exchange consideration. Then the ordinary share capital portion of it will be, they said they are using 2 of their own for every one acquired. So that will be 2/1 multiplied by how many shares are they acquiring? 12,225. 2 of their own for every one acquired. Then they are acquiring how many shares? 12,225 multiplied by what's the share price? It will be the share price
20.
of the parent. The share price of the parent is 20. But what did they give us as the nominal price? 1 naira.
1.
Ordinary share capital is always at 1 naira, is always at nominal value. So in this case, it will be 1 naira. Then share premium would have been 2/1 multiplied by 12,225. But what's the premium now? The premium will be what? 19 naira, which is the 20 naira minus the 1 naira. How much would that give us?
19.
It should be, and this one will give us what? 460. So the double entry should have been to, it's how much? The total. The total, which will be how much?
489. 489.
489,000. We'll debit investment in subsidiary with 489,000. We'll credit ordinary share capital with 24,450, and we'll credit share premium with 464,550. Do we understand?
Yes, sir.
We just say share capital. The share capital account will have what? Balance brought forward is a liability, is an equity. So the opening balance will be on the credit side as an equity. Balance brought forward 100,000. Shares they just up 2450. So that will give us balance carried down will be 124. Why? Have what? Balance. They said they have what? 42. The investment in subsidiary we sold shares for 64,550 or 64,550.
So I can't see your screen. Oh.
It will be your network, please. Can others see my screen?
Yes, sir.
Go out and join us again, please. So that should be. Hello.
We are with you, sir.
Okay. So question 10, we have what? H acquired 75% of S 80 million one ordinary share immediately and agreed to pay a further 8 million on 4th January 2007. It is its cost is 8% and capital is 6%. Required calculate the total purchase consideration. Who can tell me what purchase consideration do we have in that question? What purchase consideration do we have in that question? Can anyone try?
Deferred consideration.
Is that the only? cash consideration. They said they agreed to pay 3 naira 50 kobo per share immediately. They are paying it. So we'll say question 10. Purchase consideration is what we want to calculate. We'll say for the cash, they said they are paying what 3 naira 50 kobo per share. So if they are paying that per share, we don't even know how many shares was acquired. But we are told that they acquired 75% of SE's 80 million one naira ordinary shares. So that will be 75% of 80 million shares. And that will give us how much?
$210.
210. So that 210 is it? That 210 or 210 million. That should be 210,000 consideration. For the deferred consideration, it will be what? We say it will be A. A means A as the future value, which is into bracket 1 plus R. The R is the interest rate. We the parent cost of capital we will use. Parent cost of capital is 8%. We 0.08. And that will be raised to power minus what? How long will it take? They are acquiring the shares on 1st January 2006 and they want to pay on 1st January 2007. That is 1 year. So that will be minus 1. What do we have? Hello?
7407.4.
7407. So 0.4. Is that all? Hello?
Yes, 0.407.
407. Or we can even just write the full figure so that we'll avoid the points. So I'm not quoting in thousands again. So that means the purchase consideration will be what? 217,407 naira 407. That's the purchase consideration. That's the purchase consideration. So like I was saying, anywhere you now see this deferred consideration, you have to do what we call discount unwound. You know, the figure was actually 8 million. We discounted it. That was how we got 7 million. So unwinding that discount, you know, it's just like we reduce the figure without discounting we did. So to now undo that discount, we'll be calculating interest elements on that on that deferred consideration. So if at 1st January 2007 now we have to calculate the discount, it will just be 8% on that 7,407,407. And that will give us how much?
Five 500
592.59.
592.56.
592
592 again.
Point what?
56.
Ultimately 593. That if you now add this discount back to this initial money, it will give you the 8 million they are supposed to pay. So that is just it. The essence of discounting is to know if we have paid on the actual date we are entering into that. Because 8 million, because we are not paying. Is it clear? Is it clear?
Yes, sir.
So let's look at question 11. Let's look at question 11. On question 11, we have what? Jane acquired 60 kobo ordinary shares on 1 November 2017. Jane to pay 100,000 immediately. Also issue 3 new shares for every 2 shares acquired. And Jane will pay 90 kobo each for every share acquired on 1 November 2019. The market value of the shares of Jane and Doe are 2 naira and 1 naira respectively. And cost of capital is to have the cost of investment in Doe. So for this, this is a of the three duration. So question 11. Of what? To pay 100,000 immediately. 100,000. No need for workings. Number 2, they said they what? They said they will also issue 3 new shares for every 2 shares acquired. So that's a share exchange consideration. So for share exchange consideration, I'll split to ordinary share capital and share premium. For the ordinary share capital portion, they are issuing 3 for every 2. Multiply by what? Shares do. They have 60% because they said they are acquiring 80% of that entity. Of how many shares? We don't even know. But they gave us the share capital value to be 250,000. That will be multiplied by 250,000 divided by the nominal value of the shares, which is 0.60. Now, let me break it down for us again. By 60 will give us the number of shares in Doe. 80% of that number of shares will give us the number of shares chain is acquiring in Do. 3/2 multiplied by that number of shares Jane is acquiring in Do will give us the number of shares Jane wants to sell to acquire the shares in Do. Now, they did not tell us what the nominal value of Jane's share is. When the examiner is silent as to what the nominal value of shares is, we assume it is 1 naira. When they are silent as to what the value of shares, we assume it is 1 naira. So we'll say multiply by 1 naira. And for share premium, it will also be 3/2 of 80% of 250,000 divided by 0.6 multiplied by 1. How much? You know, what am I using? Jane's share is 2 naira. So if that means premium 2 will be 1 naira because 2 naira minus 1 naira will be 1 naira.
I don't know if it's my
Is
own
it clear?
network. I don't know if it's my own network, but the network is frustrated. I don't know if it's my own network.
It's not your only network, but it's all
He's
of us.
also
It's
doing
all
that
of
here
us.
too.
The two is just
He's doing like
frustrating.
that here too.
I don't understand, but so you guys haven't
Exactly,
been
we are
hearing me
hearing
clearly.
what you are saying, sir. Exactly.
Is it that you've not been hearing me clearly?
Sir, we've not been hearing you clearly. The network
I'm not
has been
hearing you
breaking. So I
clearly.
thought it's from here.
Yes, and the screen too is not showing.
I don't think. Can others see my screen?
We are just seeing it now. We are not seeing it before.
I don't know. Just this night alone, connected to 3 days.
The network is frustrating this night, Sha.
No,
The network generally is not favorable tonight.
Because you realize that when I wanted to start the class, it took me like 10 minutes to join. Able to join well on my phone, but it wasn't working on my system. So I had to even go and meet my roommate to allow me connect to his hotspot. That's how I was able to connect my system. Is it better now? Can I go over it again?
Yes.
Let the situation play. Okay, so just again, they've told us that Jane is acquiring 80% shares, and they are paying 100. That 100,000 they said the cash consideration, because we said cash consideration are paid what immediately. Then aside that, they said they will also issue 3 new shares for every 2 shares acquired. That is a share exchange consideration. For share exchange consideration, I've explained that to hit our recording, we'll split it into share capital and share premium, where the market value of the parent share is from the nominal value. The market value they gave us here was 2 naira, but they did not tell us anything about Jane's nominal value of shares. And I said, when examiner is silent as to what is the nominal value, just assume it is 1 naira. Now, alhamdulillah, to get the share price, to get the share exchange consideration, we'll do the number of shares they are selling multiplied by the share price. So to get the number of shares they are selling, we now say it will be what? They are saying selling 3 for every 2 shares. That's 3/2. Multiplied by how many shares do they have? We don't even know. They told us they are acquiring 80% of the subsidiary shares. So we multiplied by 80% of the subsidiary share. How many shares do we have in subsidiary? We don't know. But they told us subsidiary share capital is 250,000 and 60 kobo per share. So if we do that 250,000, which is their share capital, divided by the nominal value, it will give us what? The number of shares. If we multiply it by the 80%, it will give us the number of shares the parent is acquiring, Jane is acquiring. If we multiply by the 3/2, it will give us the number of shares they are selling to acquire Jane. To give us the number of shares they are selling to acquire Jane. Then we now multiply by that by the share, the nominal value of the shares, and also multiply it by the premium. Is it clear now? Is it clear now?
Yes,
Yes,
sir.
sir. Yes, sir.
So yeah, please give me figure.
The up one is 500,000.
500,000.
The second one is 491,803.
No, both are supposed to be the same thing now.
It's also 500,000.
When I divided it with 0.61, it gives me 491,803.
No, it's 0.60. It's 0.60. Don't mind my handwriting. So it is 500,000 and 500,000. Okay. Then the next is now said they will still pay 90 kobo each for every share they are acquiring on 1 November 2019. And when did they acquire? 1 November 2017. That means it's a deferred consideration because they want to pay at a later date. So what do? We say deferred consideration. Consideration will now be what? How much are they in the future? You know, that will be 30 kobo per share multiplied by number of shares they are acquiring, which is 80% of 250,000 divided by 0.60. All of this is just to give us what do they want to pay in the future. Then we will now say into bracket what? 1 plus R. What is our R here? The parent cost of capital, 10%. 10%, 0.1. Raised to power, how many years? They are acquiring in 2017. They want to pay in 2019. November 2019 is 2 years. So
3
that will be
years.
my.
Okay, 2 years.
So that will give us how much?
Two 247,933.88.
247,933. Please, someone should confirm the figure. 247,933 point what? Point what? Point what to
0.88.
0.88. So let's just say 934 to avoid. So what will be the total purchase consideration? That should be 1,000,000 347,934. So what will be the double entry? The double entry will be debit this to investment in dough. Credit this to deferred consideration. Credit this to share premium. Credit this to ordinary share capital and credit this to cash or bank. Is it clear? Is it clear?
Yes,
Yes,
sir.
sir.
Okay, good. So let's look at question 12. We have Picasso acquires 24 million $1 shares, which is 80% of the ordinary shares of Maya by offering a share for share exchange of 2 shares for every 3 shares acquired in Maya, and a cash payment of $1 per share payable in 3 years' time, payable 3 years later. Can you guys still hear me? Picasso shares have a nominal value of $1 and the current market value of $2. Cost of capital is 10%, and $1 receivable in 3 years can be taken as 75 cents. So what do? Calculate the cost on investment and show the journal to record it in Picasso's account. Show how the discount would be unwound. Okay, we'll have question 12. Calculation of purchase consideration. So we have share exchange. We don't have cash in this case. For the share exchange, the ordinary share capital will be what? They said they are doing 2 for every 3. That will be 2/3 multiplied by what? We don't need to bother ourselves with the percentage of holding again, because they told us that they acquired 24 million shares. I didn't mean they did not tell us that. That's when we'll be bothering ourselves with 80 million times number of shares. So we'll just say 2/3 times 24 million shares multiplied by what? Multiplied by $1, because they told us the nominal value of their shares is what? Is $1. Nominal value of shares is what? Is $1. While share premium will now be what? 2/3 also of 24 million shares multiplied by what? $1 also. Why? Market value is $2. So if my nominal value is $1, it will remain what? $1 as share premium also. And that will give us what?
16 million.
16 million each. So we'll have 16 million. 16 million. Okay, having done that, we now have deferred consideration, because they said they want to pay $1 per share 3 years later. Deferred consideration. Deferred consideration will be what? Since they said they are paying $1 per share in 3 years' time, we say $1 times 24 million shares. into bracket, we can either do 1 plus 0.1 as we are used to, 1 plus 0.1 raised to power minus 3. Or we can as well do $1 multiplied by 24 million shares, then multiply it by, they told us $1 receivable in 3 years' time is 75 kobo, multiplied by 75 cents. 75 cents will arrive at the same thing. The only difference we can have is approximation error. Oh yeah, figure please. Figure. That
The
should give
first
us
one is
what?
180315. Okay.
Exactly. So, like I said, it is the difference. The difference will be as a result of the approximation error. But once the examiner already tell you what the present value will be, just like in this case, that they've told you $1 receivable in 3 years' time is 75 cents. Don't bother using the formula method again. You get my point? Don't bother using this 1 plus 0.1 again. Just use that figure they gave you. So that will make the
50 million.
that will make 50.
Yes.
That will make it 50 million. So the double entry will be to debit investment, Abi, credit deferred consideration, and credit what? Share premium, and credit what? Credit ordinary share capital. They now said we should show how the discount will be unwound. The discount unwound will be what? To do discount unwound, it's better to use the tabular method. Just like when you are calculating your this thing. So we can say year. We can say year opening balance interest at 10%, then closing balance. So in year one, the opening balance will be the 18 million. Interest at 10% will be 1.8 million, Abi? And that will make the figure to be what? 19,800,000. 19,800,000. In year two, it will be 19,800,000. Interest will be what? 1,980,000. And that will give us how much? 21 million. Abi? 21,080,000. Am I right?
Yes.
So 21,780,000 in year three. The interest will be 2,178,000. So that will give us how much? 23 million. 23 million 8 what?
I can see your screen. No.
23,958. Is she the only one, or everyone cannot see my screen?
I'm saying this now.
Okay, is the network. Don't worry, after this question 13, we'll go and we'll call it a night. So that is that. So this thing is giving us 23,958. because we use the approximated figure. You know, when you use 0.1, this 1 plus 0.1 raised to power minus 3, it was giving you 18 million and something. I didn't mean it was that 18 million and something we used. We would have gotten the correct 24 million. But this difference is not material. Are we getting it? The difference is not material, so we can just let it go. Are we getting it? But if we have used the formula method, it should have given us exactly the 24 million. If they say they are paying 4 years, I mean, they're paying $1 times 24 shares, which is 20. Is it clear? Do we understand?
Yes, sir.
Yes, sir.
Okay, so let's go through this question 13, then we can call it a time. Can someone read for us, please?
P acquired 60% of S on 1st January 2007 when the retained earnings of S were 5,800. P paid 5,000 in cash. P also issued 2 on 1 naira shares for every acquired in X and agreed to pay a further 2,000 naira in 3 years' time. The market value of P shares at the 1st July was 1.80. P has only recorded the cash paid in respect of the investment in S. Current interest rates are 66%. The P group used the fair value method to value the non-controlling interest. At the date of acquisition, the fair value of the non-controlling interest was 5,750. The statement of financial position of P and S as at 30th June 2008 are given below. PP, property, plant and equipment.
Don't
We have a
worry.
tabular form. Okay, sir.
So, assuming all figures are correct, we are preparing consolidated financial statements for the P group. So, we'll have what? Don't forget the group and account rule is what? Number 1, we draw the group structure. P, acquiring S, 60%. NCI will be what? 40%. Date of acquisition, which is 1 July 20x7. And date of consolidation, which is what? 30 June 20x8. Note 2, we calculate what? We have to calculate net asset summary. However, with all of this information they gave us, we need to first determine what is the purchase consideration. And if you look at this thing very well, like I said, the cash consideration would mostly have been recorded. This 5,000 they said they paid in cash. Even if they did not tell us that P has only recorded the cash paid in respect of investment in SA. If you come and check here, you see investment 5,000. It is more. It is it, and they would have credited their cash or bank with the same 5,000. So, but that doesn't mean we will not include it in calculating the purchase consideration. It is still part of our purchase consideration, 5,000. What that is just telling us is that we don't need to make adjustment for it when we are consolidating. They've already posted it. Then what do we have next? He said they agreed to issue 2 1 naira shares for every 5 acquired in S. So we have share exchange consideration. of the ordinary share capital, 2 for every 5, that will be 2/5, multiply by how many shares are acquiring? We don't know, but we know they are acquiring 60% of how many shares do they have? Their share capital is 5,000. So 5,000 divided by what's the nominal value? 1 naira divided by 1. All this multiplied by what? Of their shares. Since they put 1 naira here, that means the nominal value of both of their shares is 1 naira. Then share premium will be what? The same 2/5 multiplied by 60% multiplied by 5,000 over 1 naira, but multiplied by what? They told us that the market value of their share is 1 naira 80 kobo. So if 1 naira is share capital, with what? 80 kobo will be share premium. 0.80. Then deferred consideration. You can help me calculate and put there. Deferred consideration. They said what? They said they have agreed to pay 1,000. 1,200. What about the second one?
I'm coming.
960.
960. So the deferred consideration, they said they agreed to pay a further 2,000 in 3 years' time. So we'll say 2,000 into bracket 1 plus what? The interest rate is at what? 6%. So that will be 0.06 raised to power minus 1. Please don't go and take 6% as 0.6. 6% is 0.06. So what would that give us?
One 887.
Sorry, it is raised to power minus 3. Because they said they are paying in 3 years' time. Let me correct that, please.
$1679.23.
1679.
Point what?
2.
0.23.
Okay, let's just leave that. So what will be the purchase consideration?
5,000, 6,000, 1,000, 8,000, 8,000.
8839.
8,839. So having that, we can go to note 3. Because we have this deferred consideration, I'll quickly calculate my discount unwound. Now, I'll do the discount on this. Is the year 1 alone. So I'll just say year opening balance interest at 6%. Abi? Then closing balance, because 6% is the interest rate. So for year 1, it is what? 1679. 6% on 1679 is what?
100.74.
So 100.74, just 101. Because we don't want to use point. You can actually use point though, but I don't just want to use point. So that will give us how much in total?
1578.
You are adding now.
1780.
Year 2, it would have been 1780. 6% of that will give us how much?
107.
Summation.
Two one
180.
four.
At 6% will give us what?
One 113.
113.
2000.
So that's just to show you that we like the same thing. Now that one we did not get the estimated figure. How was this? So this one will credit it to ordinary share capital account. This one will credit it to deferred consideration account. This one we're debiting it to investment in subsidiary account, but we don't really need it because we will not do that. This one now, which is we'll debit it to retained earnings of who? Of P, which is the parent. We'll credit it to where? To the deferred consideration. That's what we have to do to all of these. Those are the only thing we need there. So we can go to note 4 now. Note 4 will now be to calculate the net asset summary. Summary, POD and PAD. So DOA will have what? Share capital for how much? It will be 5,000. Like I said, share capital doesn't usually change, so we will have it as 5,000. Then share premium, they don't even have any share premium, so it's not necessary to bring it since they don't have. The next thing is retained earnings. For retained earnings, at the date of acquisition is usually different. They told us they acquired them when their retained earnings is 5,800. 5,800. Then at the date of consolidation, their retained earnings is already was 7,000 difference. I think that's 1,400, Abby. Aside that, we don't have any other thing in the assets, so we'll take a summation. Hello, am I still talking to people?
Yeah.
Yes, sir.
Okay, 1,400. Good. So note 5 will now calculate goodwill. To calculate goodwill now, we'll now say what? Goodwill should be purchase consideration. So to get our purchase consideration, we'll refer back to what we calculated earlier, 8839. 8839. Then NCI at what? At fair value, which was given to us to be what? They said the NCI fair value was 5,750. So if NCI fair value is 5,750, we can now say less fair value of net assets, which is how much? 10,800. And with that, what do we have as the goodwill? It did not tell us of any impairment, so we'll leave it at that. What do we have as the goodwill?
Three seven eight nine.
3,789.
33 what?
3789.
3789.
3789. So don't forget, because the goodwill will be for both parent and NCI, because NCI was measured at fair value. Number 6, we should calculate what? NCI. NCI will now be the value at acquisition, which is how much? 5,750. We had their share of post-acquisition earnings. So their share of post-acquisition earnings will be what? They hold 40%. 40% of 1,400 will be what?
560.
So that will give us how much in total?
60 return.
So note 7 will calculate consolidated retained earnings. So P's retained earnings will be what? $12,500. Then now say share of post-acquisition earnings. P would have taken 60% of the 1,400. So how much would that give us?
840.
840. Then what else do we have? There is a discount on warrant of 101. Is to reduce our retained earnings because we are debiting it here. So that's all. So what do we have as the consolidated retained earnings?
13,239.
So we can now go ahead and say P group consolidated statement of financial position as at 30 June 20x8. So we'll have what? Assets. We have PPE, property, plant and equipment, which is how much? 15,000 plus 9,500. How much would that give us? There was no adjustment to PPE.
24,500.
24,500. Then we have the investment. Don't forget, is investment in subsidiary, and since we are consolidating, we'll be taking that out. So what do we have next? Goodwill. Goodwill, which we calculate to be what? 3789. And after that, we have what? Current assets. Which is 7,500 plus 5,000. And that will give us how much?
12,500.
12,500. So what is total assets?
40,789.
4789. So for equity and liabilities, we'll have what? Share capital. So our share capital will be 6,000. We are not consolidating, we don't consolidate share capital or equity items. So, but we'll have it to be what? 6,000. Plus, don't forget, we issued a new share capital to acquire at how much? 1,002. So we'll say plus 1,200. That will be 7,200. Then share premium, 4,000. Plus 960, the one we issued, 4,960. Then consolidated retained earnings, instead of 12,500, we now have it to be 13,239. 13,239. So what will be the shareholders fund? Before we now bring the NCI. Give me NCI.
25
shareholders. 25 what?
399.
399.
Okay. We can now go to non-current liability. We have that to be 1,000 plus 500. That's 1,500. Then current liability, we have that to be 4,000 plus 1,800. That's 5,800. What do we have in total? Oh, sorry. Under the non-current liability, we have deferred consideration. Deferred consideration. Which is how much? 1,679 plus 101. 1,679 plus 101. That's 1,780. Then current liability 4,000 plus 1,008. That is 5,800. What do we have in total, please?
40,789.
40.
So that is that on this thing. On what is it called? purchase consideration. So in our next meeting, we'll be looking at what is it called? Fair value adjustment.